Hey, welcome back. It's really good to see you again. I'm Emma.
And I'm Nico. We're so happy you're here with us today.
After episode 1 came out, we got so many comments from people saying, I finally understand what a stock is. That meant a lot to us.
Same here. And today's episode builds on that foundation. We're going to talk about something that confuses a lot of people.
Have you ever heard someone say, I trade stocks, and someone else say, I invest for the long term, and wondered, wait, aren't those the same thing?
Exactly. Most people think trading and investing are the same, but they're actually very different.
And before we start, let me say something clearly. If you've ever felt confused when people talk about stocks, that doesn't mean you're bad at English. And it doesn't mean you're bad with money.
Right. Most people were never taught how this works. The financial world uses complicated language, and that makes people feel left out.
But today, we're going to break it down in clear, simple English, so you can finally feel confident when this topic comes up.
So by the end of this episode, you'll be able to do 3 things.
First, you'll be able to explain the difference between trading and investing clearly.
Second, you'll be able to describe your own investment style and time horizon.
And third, you'll be able to talk about stocks calmly and professionally, like someone who really knows what they're talking about.
Before we start, tell us in the comments, do you think you're more of a trader or an investor? Or maybe you're not sure yet. That's okay too.
Yeah, write it in English. We want to see you practicing. And if you're enjoying this series, please hit that like button and subscribe. It really helps us create more content for you.
All right, let's break this down.
So in episode 1, we talked about what a stock actually is. Let's do a quick review.
Right, a stock is ownership in a company.
Exactly. When you buy a stock, you own a small piece of that business.
And if the company grows, your piece becomes more valuable.
The stock market is where people buy and sell these shares.
Simple, right?
And now that you understand what stocks are, the next question is, how do people actually use them?
Right, because not everyone approaches stocks the same way. Some people trade, some people invest, and those are very different strategies.
Exactly. So let's start there. Let's start with trading. Trading is short-term.
What does that mean exactly?
Traders try to profit from price movements, up and down, in days, weeks, or months.
So they're watching the price constantly.
Exactly. Think of it like this. A trader buys low and sells high, quickly. They're not thinking about years. They're thinking about days or weeks.
Okay, so what makes trading different?
Trading means short time period, days, weeks, maybe a few months. Focus on price movements. Trying to time the market. Higher risk, potentially higher reward.
And here's how traders actually talk. Try to remember these.
I trade short term.
I'm trying to catch price swings.
I follow daily charts.
I closed my position today.
What's your exit strategy?
Okay, let's define some of these terms quickly.
Position means the stock you currently own.
Exit strategy means your plan for when you will sell.
And here's another important term, volatility.
What does that mean?
Volatility means fast price movement. If a stock goes up 10% one day and down 8% the next day, that's high volatility.
Okay, got it. So if the price jumps around a lot, that's volatility.
Now, some people confuse trading with speculation. Let me clarify. Speculation is just guessing, hoping a stock goes up without a plan. Trading is strategic. You have a plan, you manage risk, you have an exit strategy.
So trading is controlled. Speculation is gambling.
Exactly.
I remember when I first heard about day trading, I thought it sounded exciting. But I also realized it requires a lot of time and attention.
That's true. Trading is not passive. It's active. You're making decisions constantly. Investing is very different. Investing is long-term.
So what does that mean?
Investors believe in a company's growth over years, sometimes decades.
An investor buys a stock and holds it. They're not worried about the price today or tomorrow. They're thinking, will this company be bigger in 10 years?
Exactly. And here's what investing looks like. Investing means long time period, 5 years, 10 years, 20 years, or more. Focus on company fundamentals, holding through ups and downs. Lower risk over time, steady growth.
What are fundamentals?
It's like the company's report card. It shows their financial health, their sales, and their profits. It's the real value of the business.
Okay, and here's some language investors use.
I'm holding for the long term.
I believe in the company's fundamentals.
I'm building a portfolio.
I'm in it for the long run.
I reinvest dividends.
I prefer passive investing.
Let's define a few of those quickly.
Portfolio means all the stocks you own together.
Dividends are cash payments some companies give to shareholders. We'll cover that more in a future episode.
And passive investing means you're not actively picking stocks all the time. You're letting your investments grow over time.
Exactly. Now, one more thing. You'll often hear people talk about bull markets and bear markets.
What do those mean?
A bull market means prices are going up overall. Think of a bull charging forward. Prices are rising.
And a bear market?
A bear market means prices are falling. Think of a bear swiping down. Prices are dropping.
Okay, so if someone says we're in a bull market, they mean the market is doing well. The animals make it easier to remember.
Exactly. And here's how you use it in conversation. I'm bullish on this stock long term. That means you think it will go up.
Or I'm cautious in a bear market. You're being careful when prices are dropping.
Right. Simple but powerful language.
Okay, so just to make sure we're clear, let me compare them side by side.
Good idea.
Trading is short-term, days, weeks, months. Investing is long-term, years, decades.
Trading focuses on profiting from price changes. Investing focuses on believing in company growth.
Trading is high activity, buying and selling often. Investing is low activity, buy and hold.
Trading is higher risk. Investing is lower risk over time.
Okay, now listeners, think about this. If someone buys a stock today and plans to keep it for 15 years, are they trading or investing?
Think about it.
That's right, investing.
And if someone buys a stock and sells it 3 days later because the price went up, what are they doing?
Trading.
Exactly. Now, before we go further, let me say something really important.
What's that?
Trading isn't better. Investing isn't better. They're just different strategies for different people.
Right. Some people love the fast pace of trading. Some people prefer the calm of long-term investing.
And both can work. It just depends on your personality, your time, and your goals.
So don't compare yourself to others. Just figure out what fits you.
Exactly. There's no right or wrong here. Okay, so we've covered trading versus investing. But here's something most people don't talk about: risk tolerance.
Risk tolerance. What does that mean exactly?
Risk tolerance is how comfortable you are with losing money, temporarily.
So it's like, how comfortable are you watching your investment lose value, at least for a while?
Exactly. If the stock price drops 20%, do you panic or do you stay calm? That's your risk tolerance.
Okay, that makes sense.
Here are some phrases you can use to describe your risk tolerance. I have a low risk tolerance. That means you don't like seeing your money drop.
I have a high risk tolerance. That means you're okay with big swings.
I'm more conservative. That means you prefer safety.
I'm more aggressive. That means you're willing to take more risk.
I'm willing to take more risk for higher returns.
So generally, traders need higher risk tolerance, right? Because prices move fast.
That's true. And investors usually have lower to medium risk tolerance because they're focused on long-term growth, not short-term price moves.
You know what? There's actually a simple test for this. It's called the sleep test.
The sleep test?
Yeah, if you buy a stock and the price drops 10% and you can't sleep at night because you're so worried, your risk tolerance might be too high for that investment.
That's a really good way to think about it. If you're losing sleep, something is wrong.
Exactly. Investing should feel uncomfortable sometimes, but it shouldn't keep you awake at night.
That's a great point.
Listeners, think about yourself. Would you say you have low, medium, or high risk tolerance? Say it out loud.
Don't be shy. There's no wrong answer here. This is about knowing yourself. Now let's talk about time horizon. This connects directly to trading versus investing.
Time horizon. Is that how long you plan to keep your money invested?
Exactly. Your time horizon is the length of time you expect to hold an investment.
Okay, so how do we talk about that?
Here are some phrases. My time horizon is 10 years.
I'm investing for retirement.
This is a short-term trade.
I'm thinking 15 to 20 years ahead.
And here's why time horizon matters. It helps you decide what kind of investor you are.
How so?
If your time horizon is 20 years, you can handle short-term drops in price. You have time to recover.
And if your time horizon is 6 months, you need to be much more careful.
Exactly.
I remember when I first started thinking about investing, I didn't even know how to answer that question. I just thought, I want to make money. But that's too vague.
Right, and that's why time horizon matters. Let me give you some examples. If you're 25 and investing for retirement at 65, your time horizon is 40 years. You can be more aggressive and take more risk.
And if you're 55 and retiring at 65, your time horizon is 10 years. You might be more conservative.
Exactly.
Listeners, let me ask you, if you were investing today, what would your time horizon be? 5 years, 10 years, 20 years? Think about it.
So just to recap this section, risk tolerance is how comfortable you are with temporary losses. Time horizon is how long you plan to invest.
Got it. Ready for the next part?
Absolutely. Let's keep going. Okay, now here's something really important, and this is where a lot of people struggle, even native English speakers.
What's that?
Emotional discipline. Staying calm when the market moves.
Oh, that's hard. I mean, if you see your stock drop 15% in one day, it's scary.
Absolutely, and that's normal. But professional investors learn to manage that fear.
So what does emotional discipline mean exactly?
It means you don't let emotions drive your decisions. You stick to your plan even when you're nervous.
Okay, and how do we talk about that?
Here are some phrases. I try not to panic.
I don't want to make emotional decisions.
I'm a bit nervous, but I'm holding.
I don't react to every piece of news.
I stick to my plan.
So investors probably need more emotional discipline, right? Because they have to watch the price go down and not sell.
That's true. Long-term investors need patience. They need to trust their strategy even when the market drops.
I remember during the pandemic, the market dropped so fast, a lot of people panicked and sold everything. But if they had held, they would have recovered.
Exactly. That's emotional discipline. Staying calm when everyone else is panicking.
And this is different from risk tolerance, right?
Let me explain it in a simple way. Risk tolerance is how much loss you can handle without feeling overwhelmed. Emotional discipline is whether you actually stay calm or panic when it happens.
So risk tolerance is how much you can handle. Emotional discipline is whether you stay in control.
Exactly.
Listeners, here's a phrase you'll hear a lot in investing. Don't let emotions drive your decisions. Can you say that out loud?
And another one? I'm staying calm. Try that.
Good. You're doing great.
Now, one last thing before we practice. This is really important if you ever talk about stocks with other people.
What's that?
How to share your opinion safely. Because when you talk about stocks, you need to be careful.
Right. You don't want to sound like you're giving financial advice.
Exactly. Here are some phrases you can use. In my opinion,
From my experience,
I'm not a professional, but
this isn't financial advice.
I think, personally.
That's just what works for me.
So instead of saying, you should buy Apple stock, you say,
In my opinion, Apple is a strong company, but that's just what I think. You should do your own research.
exactly. That sounds much safer.
This is how calm, experienced investors talk.
Right, and that's the kind of English we want you to use. All right, it's time to practice. We're going to give you some situations, and you choose the correct answer. Ready?
Let's do this.
Situation 1. Sarah buys shares of Microsoft and plans to hold them for 15 years. Is she trading or investing? A. Trading. B. Investing.
Think about it. The answer is B, investing. Because her time horizon is long term.
Exactly. Nice work if you got that one.
Situation 2. John says, I can't handle seeing my stock drop 10%. It makes me too nervous. Does he have high or low risk tolerance? A. High risk tolerance. B. Low risk tolerance.
The answer is B. He has low risk tolerance. He's uncomfortable seeing his money drop.
Right, and that's okay. It's just good to know that about yourself.
Situation 3. Maria is 30 years old and investing for retirement at 65. What is her time horizon? A. About 5 years. B. About 35 years.
The answer is B, 35 years. She has a long time horizon.
Exactly. And that means she can handle more short-term risk.
Last one, situation 4. Your friend asks, should I buy Tesla stock? Which answer is safer? A. Yes, you should definitely buy it. B. In my opinion, Tesla is interesting, but you should do your own research.
The answer is B. You're hedging your opinion. You're being careful.
Exactly. You shared your opinion, but you stayed safe.
And that's what hedging means. It means protecting yourself. In this case, by being careful with your words. Okay, how many did you get right? If you got all 4, you're doing amazing.
If you got 3, that's still excellent.
And if you got fewer, don't worry. Go back and listen again. That's the beauty of podcasts.
Now, here's a challenge. Can you describe your own investment style in English? Are you a trader or an investor? What's your time horizon? Say it out loud right now.
Don't be shy. Speaking out loud is how you improve.
And remember, the goal isn't perfection. The goal is communication.
If people understand you, you're doing great. Wow, we covered so much today.
Let's do a quick recap.
First, we learned the difference between trading and investing. Trading is short-term, focused on price movements. Investing is long-term, focused on company growth.
Second, we learned about risk tolerance, how comfortable you are with temporary losses. And we talked about the sleep test.
Third, we talked about time horizon, how long you plan to keep your money invested.
And we learned about emotional discipline and how to share your opinions safely using professional language.
Before we go, we just want to say this. Thank you. Truly.
We love seeing your English improve, and we love hearing about your lives. It really means a lot to us.
The fact that you're here, learning about investing in English, that's something you should feel proud of.
You're investing in yourself.
From the bottom of our hearts, thank you for being here with us today.
And remember, whether you're a trader or an investor, the most important thing is to stay calm and keep learning.
Exactly. Don't panic when the market drops.
Right. Use that emotional discipline.
Keep practicing. Even just a little bit each day makes a difference.
And learning English and learning about investing. Both take time. Be patient with yourself.
Before you go, leave a comment. Tell us, are you more of a trader or an investor? Or are you still figuring it out?
We'd love to hear from you. And if this episode was helpful, please hit that like button and subscribe.
We'll see you in episode 3, where we're going to talk about how the stock market is actually structured: indexes, ETFs, and sectors.
Take care of yourself.
We'll see you next time.
Bye, everyone.
Bye.